Welcome to chapter 11. In this chapter, the focus will be on using the worksheet, a special tool utilized by accountants or in the accounting process, and focusing on adjusting entries. Let's start first by reminding ourselves what adjusting entries are. I say reminding because we would have dealt with this topic in chapter 5. And so, with chapter 11, we are shifting our focus from using adjusting entries for a service firm, one that generates revenue by providing a service, to merchandising firms, businesses that generate their revenue from the sale of inventory. It could be a wholesaler or a retailer or a manufacturer. So, what exactly are adjusting entries? Well, let's remind ourselves of what they are not. These are not financial transactions. In other words, an adjusting entry does not involve an outside entity. These are all internal entries that are made in order to comply with at least two rules or principles in accounting. One of those rules is called the revenue recognition principle. And without being too technical, it says in essence that the revenue reported in a given period should be only the revenue earned in that particular period. And so you would not want revenue that was earned outside of that period to be included. In fact, there are businesses that have been either sued or required to make major adjustments because they violated the revenue recognition principle. Then the other principle is the expense recognition principle. Usually, or it was previously referred to as the matching principle. What does it mean? Well, in simple terms, the expenses that are recorded in a given period must be the expenses that were incurred in that period, regardless of whether payment was made. And the same thing with revenue. It doesn't matter if the cash was received, if the revenue was earned, which means the service was provided, if it's a service firm, or in this case, the product was sold, then we have revenue being earned. And so, if you think about it, if the firm complies with the revenue recognition principle and the expense recognition principle, then the income statement for a given period should accurately report the revenue, the expenses, and therefore the resulting profit or loss for that period. So remember, we never use the cash account to record an adjusting entry because we are not making any payments or we are not receiving any cash. If the cash account has to be used, then we are not recording an adjusting entry. It may be that we're having to correct an error, and that's perfectly allowed, but it's not an adjusting entry by definition. Remember from the previous chapter that there are two primary ways that inventory can be tracked. One is called the periodic, where we use the purchases account to record the initial purchase of inventory, and then at the end of the fiscal period, we will make the adjustments to close out the purchases and record the unsold amount in the inventory account. Then, of course, there is the perpetual inventory method, which continuously updates the inventory account, and it certainly does make life a lot easier. Under the periodic inventory method, when we get to the end of a fiscal period, we have to close out the opening balance in our inventory account because it would not have been increased or decreased during that particular period. So we need to close that out and record the updated balance for the inventory. And so we will do that by debiting a special temporary account called income summary, and we credit inventory. Remember, inventory is an asset, so if we credit, that will decrease it or make the balance equal to zero if we record an amount equal to the debit balance in the account. Also, we will have to record the new balance for inventory, and to do that, we would debit the inventory account to increase it, and we would credit the income summary. Below, I have a quick illustration of the math, if you will, behind the calculation of cost of goods sold. Recall that that's the cost price of the inventory that was actually sold. Under the perpetual, we would not need to do this calculation because every time we sell inventory, the cost price is taken out of the inventory and debited or added to an expense account called cost of goods sold. However, here is the mathematical calculation of cost of goods sold. And if you think about it as we go through the process, it should make sense. So we start with inventory that we currently have. It could be zero if we have no inventory at the present time. If we do, then we add to it the amount that we bought during the period. So we add purchases. If we also had to pay for the freight charge, that would be added. And then we would subtract any returns. So if we bought inventory and then we had to return some of it, we would subtract that amount. We would also subtract any discounts that we receive for prompt payment. So purchase discounts or cash discounts received would be a subtraction. That gets us to a number that is called the goods available for sale. So this is the maximum dollar value of the inventory that could have been sold by this business in a particular period. Then, if we have any inventory that was not sold, we still have it in our warehouse or wherever we keep our inventory. That's your ending inventory. And so you will subtract it from the goods available for sale, and the resulting number would be cost of goods sold. This is the number that would appear in the income statement and be subtracted from your net sales to get what we call gross profit. Again, the term gross profit is not new to us. Just a reminder that this is the number that would be subtracted from our sales to arrive at our gross profit in the income statement. I'm going to go a little bit beyond what is contained in chapter 11 to incorporate additional concepts that you would find in the appendices of your textbook having to do with adjusting entries. So bear with me for an extra minute or two as I go through some examples of the major types of adjusting entries. There are really one, two, three, four, five major types or popular types. So let me go through each one and show you how they would be recorded. One of the popular types of adjusting entries would be for accrued expenses. What does that mean? An accrued expense would be an expense that we have incurred and not yet paid. For example, we received the bill for electricity that we have used for the month. However, the payment is not going to be due until the 15th of the following month, but we want to record it in this period as an expense. And so We would record the expense. So if it's electricity, it would be to utilities expense, for example, or whatever the name is for that expense account. And since it has not yet been paid, we would make a credit to a payable. Which reminds me, there is a general rule that you should bear in mind with regards to adjusting entries. I told you that it never involves the cash account. Well, another thing to remember is that one of the accounts has to be a an income statement account, and the other has to be a balance sheet account. So as you are recording your adjusting entries, just verify that one account is what you would normally find in an income statement, and the other one has to be an account that you would normally find in the balance sheet. Here's the example. The utilities expense, that's an income statement account, and the expense payable, interest payable, wages payable, any liability account, of course, is a balance sheet account, an account that we would normally find in the balance sheet. And so at least you know that this conforms to that requirement or those requirements. Cash was not used because we're not paying for the expense at this point. We're simply ensuring that we capture the amount in the current period. So that's one type of adjusting entry: accrued expenses. Expenses that have occurred or have been incurred but not yet paid. The other side of that would be what we call prepaid expenses. In this case, we have paid for the expense, but we haven't used it yet. So maybe we paid for an insurance policy for 5 months, we have only used 4 months. And if we're capturing the performance of the business for the 4 months, then we would only record the 4/5 in our income statement. And so to do that, we would take the amount that we have not yet used. This is assuming that we originally recorded the item as an expense. So let's say the insurance account had the 5 months worth of insurance recorded. We would take out the 1 month that has not yet been used and put it in a prepaid insurance or generic prepaid expense account. And of course, we would decrease the expense account to account for the amount that is not yet an expense. So any type of prepayment, it could have been office supplies that we bought and we haven't yet used all of it. So we would debit the the supplies account and credit our office supplies expense, assuming that it was originally recorded as an asset. If it were recorded as an expense, then this is how it would be recorded. If it was recorded originally as a debit to, say, supplies, then what we would have to do is take out the amount that was used by crediting the supplies account and debiting the supplies expense. So pay attention to how the transaction was originally recorded because that will dictate how the adjustment has to be done. So let me repeat that just to ensure that I provide clarity. This is what we would do if the amount that we had paid was originally recorded as an expense. We would take out the amount that has not yet expired and put it into the prepaid expense account. On the other hand, if we had originally recorded it as a prepaid, then we would take out the amount that we used and leave the unused portion in the prepaid. And in that case, we would have a debit to our expense and a credit to prepaid. Hope that clarifies for you what needs to be done. Another category of adjusting entries is for accrued revenue. So now we're dealing not with expenses, but revenue. And similar to accrued expenses, an accrued revenue would be one that you have earned but not yet received. For example, if I have a YouTube account and YouTube pays me, let's say, on the 10th of the following month, but I'm recording my revenue for, let's say, March, and I'm not going to be paid until April. Since I earned that in March, I would need to record a debit to a receivable, so a YouTube receivable, and I would credit revenue. Again, I'm not sending a bill with this entry necessarily to YouTube, but I'm saying I earned that revenue in this period, and so it needs to be captured in that period. Also, we can have unearned revenue. This would be the opposite situation where we did get the money, but we haven't yet earned the amount. And so the amount that was not yet earned goes into an unearned asset account, unearned revenue, and I shouldn't say asset. It goes into an unearned account, which is a liability account, and we would take it out of the revenue. This is assuming that it was originally recorded as a debit to cash, for example, and a credit to revenue. If we haven't earned it yet, then we need to take it out of revenue by debiting to decrease it and crediting the unearned revenue. It's also possible that we could have had something that was unearned revenue from the previous period and we have now earned it. And in that case, what we would have to do is debit the unearned and we would credit revenue. So if you pay close attention, you will see that how you record your adjusting entry depends on how the original transaction was recorded. Another type of adjusting entry is for depreciation. What is depreciation? Depreciation is really just the allocation of the cost of a fixed asset over its estimated useful life. So I buy a piece of equipment. Let's say I bought it for $11,000, and I estimate, either based on my experience or looking up the data regarding the useful life of that particular type of asset, and let us say it's 5 years. It means then that over the 5 year period, I'm going to be allocating, writing off, if you will, a portion of that particular asset. These are estimates. We could be wrong and may have to make corrections. Maybe 2 years into this, we realize, oh, it's not going to be for 5 years. It will only be for 3 years. Or maybe it isn't supposed to be for 5 years. It should be for 6 years. So it's an estimate, and we work with the original estimate until updated information indicates that we have to make a change. There are different methods for determining how much should be allocated each period. Regardless of the method that is used, the entries for the adjustments are going to be the same. That is, you will debit an expense account for depreciation. So notice depreciation expense is the expense account that will appear in the income statement, and accumulated depreciation is your asset, your balance sheet account. It's really a contra asset. And the way you remember this is an asset that has a balance that is contrary to what the normal balance should be for an asset. But the word contra really means to subtract. So the balance sheet account is accumulated depreciation, and this is your balance sheet account. So let me just quickly go through and show you the difference between two methods for allocating the cost of your asset. One is called the straight line. I think this is probably the most popular method of allocating, where you spread this amount over the life of the asset in an even way. So in this case, we have an $11,000 asset, and we estimate that at the end of 5 years, this asset will have a value, a salvage value. And I said zero here, but I'm using 1,000. So I would need to change that to reflect my actual calculations. So ignore this zero and it would be $1,000. Okay. So if the salvage value is zero, then you would have zero here, which means you would divide 11,000 by 5. I am assuming that the salvage value is 1,000. And so you take the original value or cost, subtract the salvage value, and it's going to be 10,000. Divide that by 5, which is the useful life, and it's going to be $2,000 per year. So each year you would debit depreciation expense with the $2,000 and credit your accumulated depreciation. And so each year, the accumulated depreciation balance is going to increase by $2,000. And you may recall from your reading of the text that to get to the book value, the value on the books, you take the original cost and subtract the balance in your accumulated depreciation. So after the first year, it would be 11,000 minus the 2,000, which would be 9,000. Then in the second year, it would be the 11,000 minus 4,000 because now we would have 2,000 twice. So 11,000 minus 4,000, which would be 7,000, and so on. The other method is an accelerated method where you take large amounts in the early years and then it gets smaller. This is usually the method used by businesses on their tax returns, even if they're using the straight line on their financial statements. So if you hear the expression two sets of books, it's not necessarily a nefarious statement, a statement indicating that they are trying to hide anything. It's allowed. In fact, you have to use this method, the accelerated method, based on the IRS laws, but you can use any other method for your financial statements. So let's say they were using the double declining balance method. This is one of several accelerated methods, DDB for short, double declining balance method. What does that mean? It means that they are going to double the rate that would have been used under straight line. So if we were doing straight line, it would be 1/5, right? Because we have 5 years, so we're doing 1/5 every year. So 1 divided by 5 would be equal to 20%. 1 divided by 5 is equal to 20%. And so we would double that rate and use 40%. So this 40% that I'm using, or zero point 0.4 as a decimal, is taking the straight line rate of 20% and doubling it. So clearly this number would change depending on the useful life. So if it were 4 years, then it would be 1/4, which is 25%. And therefore the DDB rate would be 50%. So here we take the 11,000. Notice in this case, I'm not accounting for the salvage value. You, it's taking the book value of the asset and multiplying it by whatever the rate is. So the book value at the very beginning is 11,000 minus 0 because there is no depreciation yet. So 11,000 times the 40% gives me $4,400. For the second year, I'm going to use the book value. So how did I get 6,600? I took the 11,000, subtracted the 4,400, and I get 6,600. Double check my math. 6,600 times 0.40 gives me, oops, typo here, of $2,600. And so we would do the same thing for the third year. Again, what's my accumulated? My accumulated would be the 44 plus the 2640. So that would be what? 4 into 6, 7,040. Subtract that from the 11,000, you get a book value, right? Original cost minus accumulated depreciation gives you your book value. Multiply that by 40% and you get 1,500. Notice that it's called accelerated because it depreciates the asset at a faster rate. Large amounts initially, and then it gets progressively smaller. So whereas it would be 2,000 every year, we have a whopping 4,400, then it drops down to 2,600, and it actually falls below the amount that was being used for straight line, and so on. Here is the key point. Regardless of the method of depreciation that is used, you cannot depreciate the asset for more than its depreciable value. So if it's going to be depreciated down to 1,000, regardless of the method used, the maximum amount that will be recorded over the useful life will be the $10,000. It's just a question of how fast we write that off depending on the method that's used. And again, just a quick side note, you can appreciate that if a firm is using a large amount of depreciation to subtract from their revenue, they will have a lower amount of taxable income and therefore they'll pay less taxes to the government. So why would the IRS require this particular method? Well, it's primarily as an economic incentive. The faster you depreciate the asset, the quick the faster you will have to replace, you will be spending money, and that will of course help the economy. That was quite a bit of information, but the bottom line regarding depreciation is you are allocating the cost of that asset over an estimated useful life. And so we are estimating that the amount is, in this case, 2,000 per year if it's straight line. So we debit depreciation expense with the amount, which is our income statement account, and we credit our balance sheet account, which is the accumulated depreciation. Another type of adjusting entry is where we are being conservative and we are allowing for not collecting on our receivables. So let's say we had $400,000 worth of receivables on our balance sheet. If we know from experience that that amount will most likely not be collected, then what we have to do based on accounting principles is set aside a portion of our profit now in anticipation of that loss in the future. So how do we do that? Well, technically what the firm would do is they would go through and analyze their receivables, and they would look at each account and determine, based on what they know about that particular customer, the likelihood of collecting 100%, 80%, 70%, and so on. And then they would come up with an overall amount. So let's just say, for illustration purposes, that they have estimated that on average, they tend to lose 10% of whatever is owed to them. So they would take the 400,000, which is the amount on the balance sheet at the end of the period, multiply that by 10% or 0.10, and they would set aside $40,000 of their profit for that possible loss. It's an estimate, just like depreciation is an estimate. So if this is wrong, we can adjust it up or down as we go on. But the first time you do this, you would debit bad debt expense and you would credit an allowance for doubtful accounts. This is your income statement account. It will go to your income statement as an expense. So in this case, the 40,000 would be debited to your bad debt expense and it would be credited to the allowance for doubtful account, which is your balance sheet account. What would happen then to this amount? Well, it's going to go to the balance sheet. And let's say we had the 400,000 original amount and the 40,000 allowance. We would have the 400,000 minus the allowance. And so the net would be $360,000. Now, that, of course, is going to be what you see on the balance sheet. So the net receivables is what it's sometimes referred to is $360,000. So to set up the allowance, we would debit bad debt expense and credit allowance. Again, we're not saying that we are going to lose $40,000 of our receivables, but we are estimating based on experience that we may. Hopefully, we're wrong and in a favorable way and we lose nothing. Or it could be that we're wrong in an unfavorable way and we end up losing 45,000. But to set it up, this is what we would do. Now, what happens if it turns out that we were to lose or have to write off? Let's say we had to write off $3,000 because now we know that this is bad. Maybe the person filed for bankruptcy and we are notified that they have done so and we are not going to be able to collect, or they've gone out of business. So we're not going to be able to collect. Even after we negotiate, we're still going to lose, let's say, $3,000. Well, thankfully, we had set aside $40,000. So notice what we're going to do here. We're going to debit this allowance. So it has a balance of $40,000. We're going to decrease it then by the 3,000, and we are going to decrease the receivables by crediting. So you can see here that the allowance is going to be decreased by debiting and the accounts receivable would be decreased by crediting. Technically, this is not an adjusting entry because notice I'm using a balance sheet account and a balance sheet account. So this would be a transaction that would be recorded at any point that we are notified of the loss. But we prepared for it by setting aside an allowance. So notice that if we made no further changes to our allowance, we kept it at the remaining, let's see, 40,000 minus 3, so we would have $37,000 left after having written off receivables totaling 3. So now my balance sheet would look like this. I would have the 397,000, right, which is 400,000 minus the 3,000 that I wrote off. And my allowance is now $37,000 because I used up 3,000 from that. And so my net is $360,000. Notice, and we're not going to go into too much of this, but notice that it doesn't change your net receivable at this point because we offset one thing with the other, so the net would still be the same. So I expanded what we were focusing on by incorporating concepts in the appendices of your textbook. So I hope you found that to be helpful. Now let's go to the show me problem for chapter 11. And it's problem 11-2b. We are given balances from the general ledger of this firm, and they happen to be listed in the proper order. So be prepared that you may have a problem where the items are just randomly listed, but if you know what they are, assets, liability, equity, revenue, expense, then you will know how to report those items in the worksheet. So in this case, it's listed in general ledger order for us. So all the assets are listed together. And you can see here that we have two contra assets. There's the accumulated depreciation, right, for these two fixed assets. Then we have our liabilities and we have our equity. And just like you can have a contra asset, you can have a contra equity, which is what the drawings account really is, because it's in the equity category. It's a temporary account, but it has a debit balance, whereas your capital account has a credit. We then have our liabilities and equity, as I said, and then we go to our last two categories, which are the revenue and the expenses. And notice that in the revenue, we have sales and sales returned, which would be a contra revenue. So whereas the sales or revenue would be a credit, this would be a debit. Same thing in here with these inventory related accounts. Purchases would be a debit, but the purchase returns would be a credit. Same thing would be true for the purchase discount. So pay attention to the normal balance for each of these accounts. And you know by now that the fact that they are showing us purchases means that they are using the periodic inventory method. There is freight, which of course is an expense, that's a debit. And then we have the other remaining expense accounts. We also have the list of adjustments that need to be made, A through H. And so we're going to be making each of these adjustments and then preparing the financial statements. So here I am in the worksheet, and we know that this is referred to as a 10-column worksheet. However, here we have our unadjusted trial balance, and so these two columns will have the balances from the ledger before any adjustments have been made. So you can see all the assets were recorded, right? The debits, if they are normal assets, the contra assets show as credits, and we have our liability or equity, we have the revenue and the expense accounts. And then down here, we have additional accounts that are needed or will be needed for adjustments. These could easily have been a part of the main portion of the worksheet, but this particular template was set up where we have to add these accounts as needed, but they become part of the worksheet as we use them. So notice that before any adjustments are made, this firm is showing a net income of 63,538. And what we do know is that that amount will change after the adjustments have been made. It could go up or it could go down. But the bottom line is this is not the correct net income for this particular period. And we know that because there are adjustments that have to be made. This is the worksheet after all the adjustments have been made. However, I would like to go through, if not all of the adjustments, at least some of them, just to reinforce the process that is involved. So focus for a second on the inventory. Based on the unadjusted trial balance, the inventory account is showing 118,628. that would be the inventory that was there from the previous period. We know that because they're using the periodic inventory method, and we are told that the amount that they now have is a different amount. Specifically, we could see that in the adjusting entry. So the first thing we have to do is get rid of the previous balance in the inventory account. So notice that we need to get rid of this debit of 118,000 plus. And so to do that, we would need to make a credit entry. And so notice that when I make this credit entry for the amount of the balance, it results in a balance of zero. That, of course, is not complete because now we need to record. Oh, and so by the way, this would be a credit to our um, inventory account, and there would be a debit to this special account called income summary. Technically, we don't need it, but I'm not going to deviate from what your textbook does. So we would debit the income summary, which is a temporary account used to facilitate the closing of the inventory, as well as the closing of the books, as you will see in the next chapter. So then we have to record the current ending inventory. And so we would debit that amount to the inventory account. So notice now that the adjusted trial balance is showing the new ending balance for inventory. So I would debit inventory, and my credit would be to the income summary account. So we have accounted for items A and B, which is to close out the beginning inventory and record the ending inventory. The next thing would be for wages accrued. So here we have an expense that was accrued, which means that we incurred the cost, but we haven't paid the employees as yet. So we need to add this amount to our expenses. And since we're not going to have our next payroll until in January, we're going to record a payable for the amount. And so in the worksheet, you will notice that we will have, if I can find our expense account, it should be here for wages. You can see that I am debiting that account for the 934, which adds to the amount already there. So now the new amount for wages is larger by 934. And of course, we have a liability, a wages payable. So we're adding to our liabilities in the amount of $934. Then the next adjustment would be for item D, and let's go back and see what that was for. Item D was for supplies inventory, and the amount that we still have is $755. So we bought a certain amount of supplies, and we still have $755 that we haven't used. So let's quickly see what happened there. You can see that for supplies, we are showing $1,850. So during the year, or sometime prior to now, we bought a total of $1,850 worth of supplies. However, we still have 755. So notice that what I have to do is figure out how much I actually used. So I'm not recording 755 because that's what we still have. So I take the 755 away from the 1850, and that tells me that I have used 1,095. So I decrease this 1850 by 1,095, and what I have remaining is what I haven't yet used, which is 755. So notice that my entry is not for 755 because 755 is what is still there should remain. I want to record all the time what was actually used. So I used 1,095 from the 1850. So I credit the asset, and that amount used is going to be my expense. And so notice here that I record a debit to supplies expense for 1,095. Debit equals credit. E and F are fairly straightforward. Both relate to depreciation. One is for depreciation of the store equipment, and the other is for the depreciation of the office equipment. Each asset is going to be depreciated at a different rate depending on how long it is going to last, but the entries are going to be the same. So we're going to debit an expense account for depreciation for each of these, and then we're going to credit the corresponding accumulated depreciation. So here you will notice that for the accumulated depreciation for the store equipment, we originally had $26,000 already depreciated. So this asset is close to the end of its useful life and most likely will need to be replaced. But the point is that we're adding $4,982 to the accumulated. So notice that the accumulated is now 31,000. So this is very close to the end of its useful life. So we have 31,000 accumulated in that particular depreciation account. So I made a credit here, and I'm going to make a debit to the expense account for the same amount. We do the similar thing for the other fixed asset. This is for the office equipment. You can see that I'm crediting accumulated. So it's going to go from the previous balance of 3410, and it's going to increase by 1,531 to 4,943. So this asset has a few more years to go, assuming that they're using straight line. But my credit here is going to be debited to an expense account for the same amount. The other item that we have to account for is insurance that expired during the year. Notice the wording on this one. This is the amount that was expired compared with the supplies that they told us the amount that did not expire. So we have to record based on the information we have. So what I'm going to do here is I'm going to look at my insurance account, and it says that this was used. So I'm going to take this out of the insurance account, and let's see if we can just, well, you know what? Let's do one at a time. So let's take care of this first. So that would be for item G. So notice that for the insurance, we're going to take out the amount that was used from the total amount that we originally purchased. So we credit 935 to decrease the asset. So this is now the new balance that will go to the balance sheet, carry over to the next period, and I'm going to debit the same amount to an insurance expense account. So this is my income statement account, and this is my balance sheet account that I credited up here. The last adjusting entry that we have to make is for rent that was earned, 2,450. So notice that we originally recorded the receipt of rental income, and now we are going to report as revenue the portion that was actually earned. Let's take a look at the worksheet to see what numbers are there. But it's saying that whatever that total is, we have earned $2,450. So here, this is unearned rent. Please note, this is not rent expense. This is unearned rent related to our receipt of rent. So most likely this business sublets, rents out a part of its facilities, and they earn rent as opposed to rent that they pay. So they received a total of 3,150, and we are now being told that they have earned 2,450 of that amount. So we're going to decrease that liability by the amount earned, and we're going to record that as a revenue or income. And so here we have a rent income or rental income that is credited for the amount. Please note, this is what we're doing because we're taking out of here the amount that was actually earned. They could have said to us that the firm still has $700 of unearned rent, and that would require us to calculate how much was earned and make the entries. So please note the wording and how you then record the item. That takes care of our adjusting entries. Notice then that the net income has changed. Recall that it was over $63,000, and now based on the adjustments, it is down to 42,448. This does not mean that adjustments will always decrease your profit. It simply means that if you don't record adjusting entries, the profit or loss that you report will be incorrect. It could be overstated or it could be understated, but it's incorrect. And so we now assume, based on the information that we were given, that this is the correct net profit or net income for the period. So we're finished with the entries. Our worksheet shows that we're still in balance, and so it provides us with the assurance that we can proceed to the preparation of the actual financial statement. So the worksheet doesn't substitute for the actual financials, it just helps to ensure the accuracy. So the income statement columns will provide us with the information for our income statement, and the balance sheet columns, which are also in balance, will provide us with the numbers that we need for the balance sheet. This page of the template is to simply officially enter into our journal and therefore ultimately into the ledger the adjustments that we have made. Because remember, these adjustments were made to the unadjusted, and so we have to post them in order for the adjusted numbers to now be reflected in the ledger. So whatever you did in the adjustments column, debits and credits, will be exactly what you do here for your adjusting entries. For example, remember the first entry we did for the beginning balance of the inventory where we credited that asset and we debited income summary? So that's what we did here. Similarly, to record the new inventory amount, we debited inventory with the ending balance and we credited the income summary. So these entries here should be exactly what you have in the adjustments column. So just go back to the adjustments column and pull out your entries, A matching up with A, B matching up with B, and so on. And so when you're done, items A through H should be now in general journal form. And again, the reason we have to do this is when these entries, these adjusting entries are posted, they will update our ledger to reflect the adjusted balances that we need to actually prepare the financial statements. So here are the numbers taken from the income statement columns of the worksheet. We have the revenue, we have sales, we have the rental income, and recall that we made that adjustment, and we have the subtraction of sales returns. The way I set up the template, numbers to be subtracted other than others that I'll talk to you about, need to be entered as a negative. So notice that if you just entered 8,848, the template won't know what to do with the number. In fact, it will know what to do. It will just add them. But if you want it to be subtracted, you have to enter it as a negative. And I think I have it coded so that it will automatically pull. I don't remember. But even if it's not done for you automatically, remember it is a subtraction, so you enter it as a negative. So this is our net sales. Then to calculate the cost of goods sold, we take the beginning inventory, we add the purchases, we add the freight, we subtract the purchases returns, we subtract the purchase discounts. Again, notice that these numbers that are being subtracted are shown as negative. So this is my goods available for sale. And then we subtract the ending inventory, and that gives us our cost of goods sold. That number is subtracted from the net sales to give us our gross profit. Then we record all of the expenses. Simply enter the expenses as absolute values because the template will add them and automatically subtract the total from your gross profit to get your net profit. In other words, do not enter these as negatives because I wrote the algorithm to add all of these and then subtract the total from the gross profit to give you your net profit. Notice that this matches, and it should, the net income that we reported in the income statement columns of the worksheet. So you know that you're doing this correctly because the whole point of the worksheet was to tell us what we should report in our actual financial statements. The next statement that you prepare is the statement of owner's equity. You start with the beginning capital balance. You add the net income that you calculated. So that literally comes from here down to the statement of owner's equity. Then you subtract the amount withdrawn. This is from the balance sheet columns. You see the drawings, subtract that, and this is your ending balance of the owner's equity for the year ended December 31, 20X1. This is important because this is the number that will now appear in the balance sheet. So do not use this number because you're saying based on your calculation that this is what the owner's equity is at the end of December 20X1. So let's move on to the final, which is the balance sheet. So the second of the major financial statements is the balance sheet, which shows the financial position of the business on a specific date. So on December 31st, 20X1, what did the business own? What did the business owe to outsiders? And what did the business owe to the owner? So we go to the balance sheet columns of the worksheet and we take the assets. So we have the cash. You can see this came from the balance sheet columns. We have receivables. We had no allowances to deal with here. So we just take the amount. We have inventory. See, this is the new ending inventory. Then we have our supplies that we haven't yet used. And we have our prepaid insurance that we are bringing over to the next period. So these are all the current assets. Then you have your fixed or non-current assets. You have the store equipment. That's the original cost. Subtract the accumulated depreciation. Notice that this goes in as a negative, and that's the book value. So this asset is very close to being replaced. And same thing here. We take the office equipment, subtract the accumulated depreciation. Notice I'm not subtracting just the depreciation expense for the current period. Go to the balance sheet columns of the worksheet and you will see accumulated depreciation because that's your balance sheet account. and it's going to be subtracted because it's a contra. Remember, contra means to subtract. So a contra asset is an asset account that is subtracted from a related asset. So this is the contra for the store equipment. This is the contra asset for the office equipment asset account. So we have current assets, we have our fixed assets, we have total assets. Then we move down to our liabilities. We have current liabilities, the notes payable, the accounts payable, the wages payable. This resulted from our adjusting entry. And then we have the unearned rent. This is the amount that we still haven't earned yet. And so that is a liability. It's possible, depending on the situation, that we may have to return this money or this amount to the the tenant. But as of right now, it is a liability, and as time passes, it will shift from being a liability to a revenue or income as we earn the amount. And finally, notice that the amount that I show here is the balance that was taken from the statement of owner's equity. How do I know that my work is correct? Well, total assets equal the sum of total liabilities plus total equity. Please contact Oliver if you have any questions regarding the concepts that were shared.